Are you a broke loser? Do you want to stop being a broke loser? Well, buy my book on Amazon. It's $2.99 for an ebook or $9.99 for a hardback. It's called Stop Being a Broke Loser. If you buy this book, you will no longer be a broke loser. So buy it now. Welcome back to Strongman Personal Finance. Today, we're going to look at what I think is a trash stock. Hewlett Packard Enterprise Company. Not the actual HP, but a split off. Now, I was looking at the stock because I heard Everything Money loved it. And I was like, this stock is freaking garbage. This makes no sense. And then I was like, wait a minute. This might be a company that split off from the original. So I went on Google. You can always trust Google. And it says right here, everything you need to know about HPE. Not HPQ. HPE, Hewlett Packard Enterprise. HPE was created in 2015 when HP, the stock that Everything Money likes, split its operation into two. On one side is HP Inc., the printer and PC arm, while HPE, the stock we're looking at, deals with enterprise products and services. Now, be very careful because you can make a simple mistake, and even I did it. I mean, I wasn't about to buy the stock, but I was looking and I was like, this doesn't make this isn't HP. And then I finally realized it was like a freaking offshoot that split off like 6 years ago. So let's look at this garbage stock, and I'm going to tell you why it's freaking garbage, okay? And I like how this article tries to fluff it up. Oh, they've been consistently growing in revenue and profit margin. The stock is trash, okay? Now, for this analysis, we're going to use Everything Money software, which I like, and we're going to supplement with Morningstar because Morningstar has a lot more data and percentages you can look at to kind of fine-tune your estimates for the stock analyzer tool. You can't just always go off Everything Money software, at least until they start pulling in vertical and horizontal analysis in from Morningstar. So, market cap, $20 billion. Revenue, $27 billion. PE, 31. Why does this stock have a 31 price to earnings ratio? Whatever. 5-year PE average, 16. Maybe they're expecting lots of earnings in the future. I don't know. Profit margin, 2.4. That's freaking garbage, okay? That doesn't necessarily mean it's a bad stock, but because it's all about what you pay for those earnings, but still, that's not a very profitable company. 5-year return on invested capital, 1.2. I mean, these numbers are freaking horrible. This is just not a very profitable company. High dividend relative to the S&P 500, 3%. Tax inefficient. I wouldn't own this company unless it was inside a tax advantage account. Let's go look at the income statement. So the company split off in 2015. They had $53 billion of revenue. And then over the next 2 years, that revenue dropped in half. They probably sold part of their business. Now, how you can verify that, if you want to see if they had an acquisition or a disposition, you can go to cash flow, go down to cash flow from investing, and then look at acquisitions and dispositions. If you see a negative number, that means they bought a company. If you see a positive number, that means they sold part of their business. So pretty much going back from 2015, looks like they bought some business. They bought way more business. Then they sold some, then they bought. So they've been buying a lot of businesses. That's how they've been kind of expanding their revenue, it looks like. Because, yeah, I don't know why that revenue dropped so much. Revenue dropped from 53 to 26. Then it stayed flat in 2017, up to 30. Stayed flat at 30, and then down and down. So the general trend is for massive fluctuations in revenue, and it just doesn't seem like it's growing at all. It seems like it's just a very flat stock. So we'll factor that in with our assumptions about revenue growth. Okay, basic average shares outstanding. So they've been buying back shares pretty consistently. The only exception was the year ended April 2021, where they issued a very small percentage of shares. But overall, going forward with my assumptions, I would assume that they're going to be buying back shares. Now, to buy back shares and pay the dividend, they need free cash flow. So, free cash flow over the average over the last 5 years was $447 million. Yep, they had a lot of free cash flow in 2021, a lot less in 2020, and a decent amount in 2019. So it's kind of freaking all over the place. But it seems like they can, at least for now, make their dividend payments. Let's see. Actually, no, they can't. Five-year average free cash flow is $447 million, and dividends paid is $619 million. So I don't know if this dividend is going to be around much longer because there's only so much free cash flow you have. You can buy back shares or you can pay a dividend. So it's even less attractive. Even the dividend is called into question. This is freaking garbage. 8 pillars. P/E ratio, average 5 years. Okay, who cares? Return on invested capital, freaking horrible. Revenue growth, barely. Actually, it's gone down. That's why this is kind of misleading. It's just, I don't know. I don't like it. Anyway, let's look at the stock analyzer tool. So, with my assumptions, I assume revenue is going to drop at the worst case or barely increase at the best case. So I said negative 2% all the way to 2%. Now, you can always go look at Morningstar. If you go down to growth, you can see year-over-year revenue growth. So starting in 2013, negative 6, negative 4, negative 5.5, negative 3, negative 42%. They probably sold part of their business there. And then they finally had some growth in 2018, and then negative and negative. So, I don't know. I think the general trend is going down. So, even being nice with just 2% revenue decline year over year going 5 years into the future, that might even be too, or not conservative enough for this company. But we'll see what the stock analyzer says with even that small of revenue decline. Share change. Now, I went negative here, negative 6, negative 4, negative 2. Actually, I did that backwards, negative 4, negative 6. Okay. Yeah, you want to have the best case on the right, worst case on the left. So I said negative 2, negative 4, negative 6, because even though you had that one aberration of share buy or issuing shares last year, the general trend is year over year over year over year, they've been buying shares back. So I don't know if that was just a fluke over the last year. So I'm going to say negative 2, negative 4, negative 6 over the next 5 years. Profit margin, 2, 3, 4. Once again, I refer to Morningstar here. I go to key ratios, I go to profitability, and I look at net margin at the bottom. That's the profit margin. So you see it's wildly fluctuating. 3.5, 3, 4, 4.7, 6.3, 1.1. And most recently it's been 6.1, 6.2, 3.6, loss in 2020, and then 2.3 over the last 12 months. So I, in my personal opinion, think 2, 3, and 4 is pretty reasonable. That's why I like Morningstar so much, because you can actually reference and kind of get like a better feel for those percentages. PE, I'm always conservative with PE because that's the final multiple that you would potentially sell the business at. 8, 10, and 12, same for free cash flow. You click Analyze with a 15% return. The stock's freaking garbage. Even with the best assumptions. 2% growth, even though revenue's been declining. Share change, buying back 6% of shares per year. 4% profit margin, which they're not even close to. Free cash flow as a percentage of revenue, 5%. PE 12, I mean, I don't know. Maybe if we bumped up the PE for the best case to 15, let's see what that gives us. Okay, at that point, it's a buy for discounted cash flow, but not even close for earnings. Assuming that revenue grows, shares get bought back at a high rate, profits 4%. I just don't see it. I think this company is freaking garbage. Now, this is in contrast to the other HP, the HPQ that Paul bought. That's a pretty tempting buy, which I'm going to look at that later. But in my personal opinion, what I'm doing right now is waiting for the end of this year. And on January 1st, 2022, I'm going to max my IRA and my wife's IRA. It's $12,000. And at that point, I'm going to start saving for next year's IRA. But if I feel like I have enough money to where I can start making individual stocks purchases again, then I'll consider maybe HPQ. But I'm not buying this freaking trash, HPE. It's disgusting. I don't even know why the stock should be delisted. It's disgustingly bad and nasty. But you know what? Maybe you can use different assumptions. I would recommend you use Morningstar to supplement them, but it's up to you. So overall, trash, garbage. Do not mix this up with HPQ, please. Because if you do, you're going to be down at the truck stop if you buy this stock on accident. They need to change these freaking names if they spin off companies. Because even I was looking at this, I was like, what? How is this? This is not good. Anyway, that's it. Like, subscribe. Tell your friends about me. Y'all have a wonderful, delicious, superstitious, cockalicious day. Choo!